Uh, okay. So none of my comic relief is going to be part of our recording. Okay, you guys, debt to income ratio. If everybody can take a second and mute yourselves, I probably have control over that and muting all of you, but do me a favor so I don't have to look for it. Will you please just take a second and look at your settings and mute yourselves just while we get through this part? You'll have opportunity to unmute yourself so that we can have that interactive or collaborative back and forth later on in our conversation. So debt to income ratio is what we're going to be talking about. I thought it was timely because this time of year we're closing out 2024, obviously. This is Ridge's busiest time of the year because we've got, for a few reasons. One, because we work so heavily with investors, everybody wants that year-end tax credit, right? So everybody and their brother is clamoring to get their transactions closed, et cetera. And the reason that that is problematic for us is that in our industry, the lending industry, everybody else, all of the professionals be it from appraisers and insurance people, underwriters, processors, everybody's kind of on hiatus, right? We're dealing with skeleton crews because there's no owner occupied deals really going on right now, refinances and purchases. So we're kind of short staffed to begin with. We got lots of extra volume this time of year for the tax purposes. And then we have short months with the holidays, right? So for all those reasons, it's just such a crazy time of year, but it is also opportunistic. So here's when we can really, and I thought the debt to income ratio topic right now would be useful because coming up in 2024, whether you're, Johnny on the spot and you file right on time or early or whatever, and depending on what your goals are for 2025, it's going to be really important depending on where you are stationed in your journey of real estate investing. And if you still need that full doc loan, I'll explain that in a second. The Schedule E specifically, which is what we'll spend a lot of time on today, is something that we can optimize. Okay, I'll get into that. So let me start with, and by the way, you guys, for those that weren't here initially, I just had knee surgery 5 days ago, and I thought it was a great idea that I was capable of being prepared for a DTI conversation 5 days out of knee surgery, which admittedly I am not. So I'm winging it a little bit. You guys are used to that. It's just how I roll. So we're going to start with a definition of debt to income ratio. I've got some notes over here that I'm going to be looking at, and then I'll be sharing screen, okay? So DTI, a lot of times, just the acronym of that, people they feel kind of intimidated by debt to income ratio. They think it's a lot more complicated than it is. And depending on the type of income that you claim, it certainly can be more complicated. But for most people, it's not nearly as complicated as we imagine it is. Debt to income ratio. So debt to income ratio is a calculation of monthly income that we will extract from the documentation that you supply us, and we're going to divide that by the monthly liabilities found almost exclusively on your credit report. Now, I'm going to come back to that in just a second, okay? I want to really just take a quick second and define when debt to income ratio is going to be something you need to focus on. For individuals that have either maxed out their 10 golden tickets, right? Fannie, Freddie, we've got 10 per qualified individual. Those are full income documentation loans. The vials of blood and DNA samples that I joke about, that's those people. If you've either maxed those out, you've already gotten all of them, and until one pays off, you're capped out of the full doc loan, chances are you're going to move into a DSCR or non-QM. Now, you don't have to necessarily go DSCR, but the rate difference between a full doc loan once you've maxed out your Fannie Freddie 10 and a DSCR is negligible. It's really irrelevant. So more often than not, investors that have already gotten all of their 10 golden tickets set, they're going to move into the non-QM and they're going to take the DSCR loan because it's less documentation, right? It's less paper pushing they have to do. And the interest rate between that and say a full doc loan where you would supply updated tax returns and pay stubs, et cetera, there's really not much of a spread. So most people after the Fannie Freddies, they graduate into the non-QM space. QM stands for qualified mortgage. And the DSCR is where they're going to go. But non-QM actually has full doc, bank statements, asset depletion. I will cover some of that here in the next hour, but DSCR is where they're going to go. Debt to income ratio is individual, okay? DSCR is debt service coverage ratio, where we are focused on the property exclusively and the income of that property and dividing it by the PITI, principal, interest, taxes, and insurance, and HOA if it applies. All right. So today, the debt to income ratio is really for those individuals that is more often than not going to be still in that first 10 Fannie Freddie golden ticket space. Now, there are some circumstances where even if you've maximized those, that you may be in a debt to income ratio versus a debt service coverage. So it might be worth paying attention and understanding this. Or let's say that your circumstances are that currently you can't qualify for DTI because you were a W-2 employee and you decided to become self-employed and you don't have a 2-year history yet. So in that case, we can't give you the income. So you're going to have to look at DSCR for investing, at least temporarily, until we can get you back on track and show you the path to go back on the DTI. Why do you guys care between going DTI if it's available to you or debt service coverage ratio? Well, depending on the property, obviously, and what the numbers look like, it may not be as important or relevant, but overall, the DTI product, Fannie Freddie, is going to give you better terms. Okay. Lower interest rate, less points probably, et cetera. So there's advantages there. So debt to income ratio for most individuals that are going to be listening to this is going to be for those that still have Fannie Freddie loan spots, and it will be individual income divided by monthly liability. Okay, that's who DTI is important for. And the timely piece about looking at it this year is that once we get into 2025, and depending on what your goals are next year, it'll be really, really important to make sure that debt to income ratio is in a space that will allow you to do what it is that you want to do within your goals for next year. Okay. So let me take that and move into that. I'll go back into the debt to income ratio definition. So I started by saying it is the monthly income that we've extracted from the documentation that you have supplied us, and we're dividing that number by the monthly liabilities found almost exclusively on your credit report. Now, for those of you that have one-on-one time with me and have done the certified power buyer, you've heard some of this before. I think it bears repeating anyway. But let's talk about, I said almost exclusively on your credit report. Now that almost is applicable to 3 different criteria. These things are still going to need to be included in a debt to income ratio calculation, but they will not be found on your credit report. They are going to be rent. If your primary housing expense is renting, you don't own your home, primary housing expense must be included in a debt to income ratio. Won't be found on the credit report. That would be number 1. The second thing would be HOA dues on any property that you own. Those will also not be found on a credit report. Have to be. It's a hard cost of the property. You guys mute yourselves, please. Has to be included in the DTI. And then finally, taxes and insurance. Okay. For those individuals, hey gang, will you guys take a second, please, and look to mute yourselves? Let me see if I can figure out how to mute everybody. Let's see. Oh, it looks like whoever it was, they caught it. So the third thing would be if for those individuals that have taxes and insurance paid separate from your mortgage payment. Okay, it's not impounded, it's not escrowed. You have elected to just make on your monthly mortgage payment is just the principal and interest. You pay your taxes yourself, you pay your insurance yourself. Those are the other monthly expenses that we will not see on a credit report, but they must be included in a DTI. And that's it. And the reason that I go into all of that detail is because a lot of people, when they hear debt to income ratio on an individual basis, they assume that ordinary living expenses play a role. Your food and your gas and your utilities and your cell phone bills, right? All of those things that we have to pay day in and day out for living reasons, right? I mean, they're going to come up. DTI does not include any of that. It is exclusively on that credit report. And more importantly, it's the minimum payments on that credit report. I don't care if you have $50,000 on a credit card. All I care about is that monthly payment that's going to be listed. There's some other details about that. If we have time, I'll get into, but for now, I'll just leave that there. It's going to be the minimum monthly payments on the credit report, with the exception of those 3 things. Rent, if that's your primary housing expense. HOA dues, and taxes and insurances on mortgages that you have elected to pay separately. Otherwise, income, monthly liabilities, you divide those two numbers and that's it. Okay, it's really not that complicated when you peel back some of those layers. The threshold for debt to income ratio and qualifying conventionally is 50%. 50% income to the monthly liabilities. So whatever that income is times 50%, all of the expenses have to fit in within that 50% max debt to income ratio. I'll probably give you guys some examples on that in a minute. So that's the baseline, okay? If we think about W-2, let's talk about the different types of income that we see that are pretty general or pretty common. You've got obviously the W-2 stuff. W-2 is extremely easy and probably the easiest of them to calculate. We're going to take your gross income, okay? The gross income on W-2, annual, divided by 12, and that's what you get for the income, and then you do that same division. If you make commission or bonus income, we're going to take a 24-month average of that, okay? Similarly, for self-employed people, let's take a quick second and talk about Schedule C for us self-employed individuals. Schedule C, if you've got 5 years or more to demonstrate that you've been self-employed. Let's see, how do I mute? There we go. Schedule C income, we need typically a 24-month average as well. However, if the individual can demonstrate that he or she has had self-employed income for 5 years, we can show a CPA letter or a business license, or right, there's different ways that we can demonstrate that. If we can show 5+ years of self-employed income, then the rule changes to the last 12 months, most recent filed tax return, 12-month average, and that might be to your advantage. As an example of how that would look, let's say that 23 was a much better year than 22, okay? Or yeah, 23 was a much better year than 22. Normally, we'd have to take a 24-month average, which would reduce that monthly income, right? If 22 said 10,000 and 23 said 20,000, if I add those together and divide them by 24 months, okay, that's going to be a lower number than if I can just take a 12-month average of the 20,000, right? So for self-employed Schedule C, simple Schedule C, the rule is if we can show a 5-year continuance that you've had that kind of income, then it's a 12-month average. Otherwise, it's that 24-month average on the Schedule C. Beyond that, we get into more complicated types of income. For those that are incorporated, S Corp, C Corp, and the K1s, there's different worksheets and calculations, liquidity tests and things like that. We'll probably get to that after we've graduated a few of these. That might be part 5 or 6. Who knows how far we take this. There's quite a rabbit hole that income calculation for the more complicated side can be. Anyway, so that's just kind of a quick overview. W-2, super simple, gross rents, or excuse me, gross income, divide it by the 12 months, and that's what we can give you. If there's commission or bonus, just be prepared that we need to see a 2-year average of that to give you that overtime. Similarly, we're going to take an average if you make overtime. We talked about Schedule C. Now, Schedule E is really where I want to put our focus on today. Schedule E is where the rental income, for those of you that do not have rentals yet, that are just kind of getting started, it is the Schedule E of a federal tax return. Let me take a pause and quantify for you. We don't care about state tax returns. We never look at them. They are irrelevant to us. The only thing that we care about is a federal tax return. And on a federal tax return, you have different schedules. There's a Schedule C, we talked about that. That's where self-employed income is going to be. Schedule D, dividends. Schedule E is where the rental properties will go. Now, let me take a quick second. This is kind of jumping ahead, but I think that it's important, and I'm probably going to repeat myself because this can be a make or break, and I see this as an error all the time. And it's a difference between your CPA thinking that there may be some extra benefit for asset protection in filing it in a certain way versus from a lending perspective and optimizing your debt to income ratio. Let me explain. So Fannie Freddie's rule, when we talk about Schedule E and rental income, et cetera, and I'm going to say this a couple times, you guys, because it takes a minute to connect the dot. If you have personally obligated the mortgage debt, or you let's say the mortgage is in your personal name, or you've signed a personal guarantee. Let's say you went out and got a commercial loan, okay? And the loan and title both closed in the name of the LLC. But you, Mr. Jones, went and signed a personal guarantee to that loan. You have personally obligated to the debt. Okay, so whether it's in your individual name or you personally obligated the debt, the following rule applies. If your CPA has encouraged you or coached you to say you want to file these properties on a business return, its own business return, enable AI companion. I don't know why it's telling me that. It keeps popping up, you guys. I'm sorry. Okay, we're going to ignore that. Forgive me. See, that's why I need my moderator, my tech person. If you have personally obligated the debt and you file a business tax return where those properties are going to fall versus on your personal Schedule E, the Fannie Freddie rule says that if there's a gain in the calculation that I'm going to go over shortly, you cannot have it in the DTI calculation. However, if there's a loss, I will absolutely hit you for the loss up to a maximum of that property's PITI, principal, interest, taxes, insurance, and HOA if it's applicable. I'll show you an example of that when we get into the worksheets and things. But for this purpose, and the first time I'm saying it, if you have any questions about how you want to file a tax return related to residential, I don't care about commercial as much, residential real estate, and whether you're going to file it on your personal tax return Schedule E or its own separate business return, please have a conversation with us so that we can look at it together and I can give you my best advice. Let's go mute. Who else is unmuted? You guys, please remember to mute yourselves if you can, just to keep down the background noise. So the only time I think it's going to be justified for your own purposes, for tax purposes, not asset protection, two totally different things. And I feel like CPAs get that
like running.
confused. Yeah. And this is why everybody encourages me to keep control of the.
I don't know if it's the same as the rapid. I didn't get my
Hold on,
password.
Hey guys, can you mute yourselves, please?
Enter password.
This is my bad. I thought I was being so smart to just give everybody access.
I don't know.
I'll call them for the tag, okay?
Yeah, they might have to come do this because I don't have. I'm hoping.
You should be able to hover over the top right of their and then just hit the mute button. It'll tell you to mute.
Yeah, there's enough people on here. I got to open it up to see which it is.
Yeah.
I'm sorry, you guys.
Letitia Pearson, because she's lighting up when you hear it.
No, I never got a.
Caeli, you should be able to mute all, actually.
I should. Where is it? Is that Jag?
Yes, I think the gentleman was just saying top right.
Under more, pause, breakout polls, disable annotation.
Hover over their profile in there where you see their.
And do it individually. Yeah, I've done that a couple of times, but I can't identify who it is that we're hearing.
The box will light up. Will light up with a green thing around it when they're talking.
Yeah, because I'm sharing screen. It's not doing that for me.
So everyone just check your mics and mute yourself. So
If
whoever
could,
Vincent
guys.
Scott is, you need to move. Whoever Ron Thomas is, mute yourself. Whoever 78.
Keisha, I just muted you. You were the one helping me and I just muted you. All right, hold on, you guys. What a shit show. I'm sorry.
Yeah. They can see whether they're over budgeting a person or not.
And when you say all the projects, does it include the
That's Rakesh from Margaret.
Yes.
So artificial projects.
Well, what I'm thinking about is, they should have indirect projects.
Is there a way to drop this person? The person was not muted yet.
Yeah, I found it. I found the way to get the gallery so I can see everybody. Okay. Note to self, don't do it this way again. Mute that dude. Who else isn't muted on here? I think we might have got it.
Rakesh is not.
Maybe not.
Rock
Oh, there it
cash.
is. There it is.
30 of which is for sick days and leave.
Okay, muted. I'm so sorry, you guys. Okay, CPAs, asset protection, and tax benefit. Okay, residential real estate. General rule of thumb, do not file it on a business tax return. You want it on your personal tax return. If you're within the 10 golden tickets, it'll be important to your debt to income ratio not to have it the other way. Okay. Probably for deeper conversation on a one-on-one basis, let me know if you're being given that advice, and we can look at it together, and or with your CPA, right? Your CPA is there to save you money in the tax column, right? Which of course we are too. We understand that as part of the beauty of real estate investing, but we want to be able to come in from behind and say, okay, let's make sure that while we're maximizing over here in the tax column, that we are not disqualifying or diminishing your ability to qualify in the DTI column. So there's some give and take there. So if that applies to you, someone's telling you to file your personally obligated mortgages. If they don't have any mortgages, then it doesn't matter. Okay, you're not going to get the gain probably if it's on a business return, but just, or we can answer questions at the end. All right, that derailed me a little bit. Let's get into this. I'm going to share my screen, and now we're going to look at the worksheet. So one of the things that I want to share with you guys, make sure you guys can see this, right? Let me look at your faces. Yes, okay, good. So Fannie and Freddie publish, and if you guys wanted any of these, I'd be very happy to provide them for you. These are pre-formulated income worksheets. This is the Schedule E. This is the rental income worksheet that you see on your screen. It's already pre-formulated. And what we do with this is we simply, let's say the different schedules, so Schedule C or D or K, right? The different types of income that you may be claiming that's not just the straight W-2 has its own unique worksheet that we take the data from a tax return and we input it appropriately on the worksheet. So as I've mentioned a couple of times today, we're really going to focus on the Schedule E. So this is a Schedule E worksheet, okay? I'm going to take you through the different cells here in a second. And here is the Schedule E, redacted Schedule E that we're going to be working from. Okay, for those that have maybe new or you don't spend a lot of time looking at your Schedule E, I will tell you that this is how they look. On a personal federal tax return, there are, well, the schedule is always, regardless of the schedule, is going to be up here in the top left, and the year in which it was filed is going to be in the top right. Okay, so we've got per page, there are 3 properties per page of a personal Schedule E. If this was on a business Schedule E grid, there would be 4, but there's 3 on a personal. So if an individual had 9 rentals, for example, they're going to have 3 pages of Schedule E. All right. And before I get into the worksheet here, let me just kind of take you through what you're looking at. So you've got A, B, and C, rows A, B, and C. Property addresses are going to be listed here. Okay. The number of fair rental days will be listed here, and they correspond A, B, and C appropriately. And this just means how many days the property was in use as a rental. Okay, I'll have some commentary about this in a minute because this is pretty important, but I'm going to come back to it once I get into the worksheet. And then obviously you can see A, B, and C rows here correspond to the columns A, B, and C. Oh, look, I redacted the A here. I didn't mean to do that. A, B, and C down below. Okay, addresses. Here's the data points for each of these properties on the Schedule E. Now, it starts here at income. Okay, royalties received. I'll tell you guys, I've been doing this for 25 years. I don't know that I have ever seen data numbers in this row, in row 4 here. I don't think I ever have. I don't even know why you would have royalties on a Schedule E anyway. Not important. So the rents, the income that you're claiming for the year are going to be listed right here in row 3. Then you jump down to rows 5 through 19. Okay, these are the expenses. You got things like advertising, travel, cleaning, insurance, management fees if you're claiming it. You've got interest, mortgage interest that you're paying, repairs, supplies, taxes, utilities, depreciation, and then there's a line for other things that wouldn't be listed here that would be legitimate expenses. And then finally, for our purposes, Line 20 is the total, 5 through 19. Total expenses 5 through 19. So you have your income up here, top box, and then you've got your total expenses all in for these different things on row 20. Now, I'm going to move this over to a different screen, okay? And I'm going to show you some input so that you guys can follow along. So you'll notice I have the addresses. So on this worksheet, well, let me just take a quick second. So I want to draw your attention really quickly, you guys, to column E, okay? Column E on this worksheet, you've got an enter and a subtract, an add, total, divide, subtract, result, okay? This will be important in a second. So the first thing that I do when I get a Schedule E, a tax return, and I'm going to do a Schedule E worksheet, is I'm going to put in the addresses in the order in which they appear on the Schedule E, ABC, depending on how many pages there are. So I'm going to list the addresses out. The next thing, and honestly, you guys, and anybody that wants this, you just tell us. We'll give you a blank copy and you can kind of mess around with it on your own, see if you can figure it out. If you really slowed down and looked line item by line item, it tells you exactly where you need to go and what you're looking for. Okay. So address here, then you've got the number of months the property was in service. It says it down in there. It's hidden. Come on, mouse. What's happening to you? Oh, don't do this right now. Here we go. Okay. So you've got the number of months the property was in service. So that's, remember I showed you guys a second ago, this. Fair rental days, 365, 250, 365. The reason that this is so important, and a lot of times I notice that CPAs, their software just defaults no matter what to the 365. Okay. That could be a problem if it wasn't accurate for this reason. So if I know that Mrs. Jones purchased the property in June of the prior year, but the tax return that I'm looking at to do the worksheet for her or with her together as an exercise shows 365, that means that I've got to put the number 12. The property was in service for 12 months, right? The days we break it down into months, okay? So if I know that she only owned that property for 6 months, but the CPA defaulted to 365 days, 12 months is what I have to use. That's what's on the tax return. I have to use it. Now, there could be some workarounds and some letters of explanation, et cetera, from a CPA. But overall, these are some of the things that we would be looking for when we get our clients draft tax returns, which reminds me, draft, I'll come back to that in a second. But watch, I want you to just to illustrate this particular point. So there's 12 months in here right now, okay? I want you to look at this bottom number right here, the result number. Watch what happens if this were 6 months. If it was, let's say it was supposed to be 6. See what happened there? We're dividing by this number, by the number of months the property was in service. So the income that we're showing is being divided by the number of months that we're saying that that property was rented. So I went from $450 or whatever it was in income. And if I corrected it, because this property really was purchased middle of the year and should have only said, you know, half that amount in days, I've just lost almost $1,000 of income. That's a big deal. So these are some of the things that we are going to be looking for when we ask, when we ask to see our client's draft tax return. I will come back to that draft in a second. So anyway, the number of fair rental days is important. Now, can you use a different number if it was just vacant for 3 months? No. The only time that that's applicable is that if the property was purchased later than the first of the year, or you didn't have it that long, or if it was under major renovation, in which case then absolutely we can adjust the days of fair rental service. If you just lost a tenant and it went vacant for 2 months, you don't get to just put 10 months there, okay? Then we have the income. Next column, the income, total rents received. You guys remember where I showed that on line 3 of your Schedule E? It says rents received right there. So you have the income that we've claimed. And then the next column here is a subtract, the total expenses. If you recall, it's line 20, okay? Line 20 is the total, lines 5 through 19. So all the expenses added together, we put here as a subtract. So what's happening is we're subtracting the total from the income. So what is that? About $6 grand? 6,300 is the income that I have right now. Okay, once I do those two, or just that simple math. Now what we get to do, remember I showed you this column a second ago, we have add backs. There are certain things on the Schedule E that work to our advantage. These are going to be things like the insurance is an add back. The interest is an add back. Taxes, add back. HOA dues, add back. Depreciation, because it's a paper loss, is an add back. Things like amortization are also add backs. I'll have an example of that in a second. And then finally, and this is pretty important, okay, I'm going to take a second on this. One-time extraordinary expenses. So in the mind of Fannie Freddie, a one-time extraordinary expense would be something like a new furnace, roof repair, foundation issue. If it was for education, right? You claimed education that you paid for some mastermind group or something. That's not going to be considered a one-time extraordinary expense. Landscaping is not a one-time extraordinary expense. It's something that continues to happen. So if it's legitimately a one-time extraordinary expense, more often than not, we're going to find that expense on one of two places: under repair, which is row 14, or under other statements. And I'm going to show you some, I don't know that I have examples of true add backs, but we'll look at the statement. I have that here on the second page. I'll get to that in a minute. Okay. So generally speaking, if we do have a one-time extraordinary expense and we can legitimize it via paper trail, let's say receipt or invoice, okay, I have to be able to prove that it was for what we say it was as a one-time expense before I can use it as an add back. Okay. Ideally, I'm going to have you put it here under repair. Other is fine as long as it's listed out appropriately, and we have those paper trails to prove it. So that is also an add back. And then finally, we've got a total. Okay, so we entered in our income, we subtracted the total expenses, and then we added back those items here that I just went over, and that gives us a total. Then we're going to divide it by the number, we talked about this, the number of months that the property was in service, and that gives us our monthly adjusted rental income. Final step is a subtract, another subtract, which is the equivalent of the PITIA, principal, interest, taxes, and insurance, HOA if it applies, or maybe it's just TIA, maybe it's a free and clear property and there's no mortgage, in which case you would do 1/12, right? The monthly is where this is. We do the monthly of what those hard costs would be. Again, principal and interest if applicable, the monthly taxes, the monthly insurance, HOA if applicable. That's the number that's going to go in this final cell here that will then deliver us with the result of a gain or a loss. Okay. Now, the reason that these guys are add backs, in this case, we have insurance, interest, taxes. Let's just use those first three to start. Those are hard costs, right? Those are add backs because I'm taking them away as 1/12 of the annual down here. I'm not going to hit you for it twice. I'm adding back here on the Schedule E because I'm taking it away as the PITI down here. Okay. The other add backs, obviously, as I mentioned, are paper losses or one-time expense. Let me look at you guys and see how we're doing. Anybody, why don't I take a quick minute? Actually, you know what? Hold that thought. Let me go through, let me do one other thing, show a couple other examples, and then we can open up to some questions. So so this particular property for the year in which we're talking about is producing a gain of $436 a month. Now, all the properties that may be included here, somebody's saying he can't, can you guys hear me? Yeah, I saw, there's my friend Vincent. Hi, Vincent.
Yeah,
Okay.
I can hear you fine.
Okay. All right. Somebody can't hear me. Aziz, I don't know what you're talking about, man. I don't know. Sorry.
It's actually the AI.
Oh, thank you, Lorena. Okay. Well, I don't know why the AI
I can
can't
hear
hear
you.
me.
That's what I was about saying.
Okay. All right. So this property is at a gain. Okay. What I would do, all the properties that this individual owns, we're going to take the sum, which by the way, on this worksheet gives us the total down here. It's formulated to give us what the total is, but the pluses and minuses. Now, real quickly, I'll show you something else. So let's say that, and this will probably be for a part two. Okay, this starts to get a little bit more technical. Let's say that we have 3 properties on the Schedule E, but there's 3 other properties that were just purchased in an acquisition year that have not found their way on a Schedule E. That data is a different formula, and it's going to go down in here in step 2. That's when we're going to take, most of you are probably familiar with this, we're going to take 75% of the gross rents minus the proposed principal, interest, taxes, and insurance. Okay, if the gross rents on a property that was purchased in the acquisition year, let me define acquisition year really quickly. So from the date that you've purchased the property and up until that year's tax return has been filed. Example, let's say that you purchased a property in January of 23. You bought the property in January 23, and you did not file 23's return until right on the button April 15th of 24. The following formula I'm going to give you would be applicable to that property from January of 23 until April of 24. Now, if that person filed an extension, the following formula would apply to that property potentially from January of 23 until October 15th of 24. That's how long we buy if we file an extension, which, by the way, that's part of strategy. One-on-one coaching with Ridge, with me, about how to optimize debt to income ratio. Some of those details will come up. If looking at draft tax returns and saying, okay, Mr. Jones, I want you to file an extension. Okay, I want to use the prior year's tax return. It looks better for the debt to income ratio. Let's buy 6 months time between April 15th when they're due and October 15th when they have to be filed, right? If you filed an extension, I want to use the prior year's return, and or I'd like to use the acquisition year model formula. That one's going to be probably more favorable. And here's the formula, and here's why. Acquisition year formula is applicable, right? We said from the date that you purchase it until it lands on that schedule, on the Schedule E filed tax return. Gross rents times 75% minus the PITI. Let's say the gross rents are $1,000 a month for easy math. I can give you up to 75% of the 1,000, 750, right? We have $1,000 of income. I can give you 75% of 1,000, so you got $750 of income. Now with that, I have to subtract out the PITI. Principal, interest, tax, and insurance. I know I say it a lot, but some people are still getting used to the language. Let's say that the PITI is $500 a month. Well, I've got $750 here. If my PITI is $500, I got to take that out the top. That leaves me with what? A $250 gain, right? That's the easy math example I always give. For people that can demonstrate that they have 12 months history of being an investor and a primary housing expense, whether you own your home or you rent, that person gets the full $250 gain in the example I just gave you. For the person that only has one of those two distinctions, primary housing expense or 12 years history of being an investor, I can give you an offset, which means you don't get the $250 gain, but I can give you up to the $500 PITI. For the Mr. or Mrs. that has neither of those two distinctions, in acquisition year formula, they get 0 of the rental income to offset the new mortgage debt. Okay. In any case, my point is that calculation will be derived down here. You will never have a property address in this field up here and have data in the top columns and down here. It's one or the other. It's Schedule E or it's acquisition year. So let's just say that there is another property here, 123 Front Street. Okay, and this was recently purchased and the rents are $1,500 a month. It does the math for us, 75%. Now, the final thing is I got to put in the PITI. Let's say it's 682. So that property is cash flowing at 443 a month, and it'll give you that total down there. Okay, it does all the math for you. Okay, let me give you some other quick examples. Let's go back here. So I input all the data for us based on this Schedule E. Now let's look for some things that might be useful. Here's one right here. So the days fair rental, 250. So I did the math, right? I took 250 divided by 30, and I came up with the number of months. We're always going to round appropriately the number of months that we need to select. So that's one kind of offlier that we have to be looking for. Let's look at some other things here. So we have, oh, look at this. There's no insurance. Now I remember something vaguely about this, and I don't know what it was, but for our purposes in this example, I'm just going to say that it was a miss. Now, this is a good pausing point to talk about drafts, and then I'll get back into it. It's very, very important. If you want to qualify, if your goals in any calendar year are to qualify, especially conventionally, if that's important to you, I'm constantly telling my clients, new and old alike, do not file any more federal tax returns until we have seen the draft version first. I want that draft, and in which case, this is the exact exercise that we're going to do. And we'll even do it together if you want. Okay. I'm going to take your draft Schedule E before we've rung the bell, and we're going to take this pre-formulated worksheet and we're going to go through the pluses and minuses and see how it shakes out. And that's when I'll be able to give you the advice that says, this looks great, file your tax return. Or, hey, listen, I want you to file an extension this year. I want to use this other year's return and or that more favorable acquisition year formula. Maybe that's part of it. Maybe you purchased a property in November, late in the year, and there's not a lot of income to be gleaned, but there's still quite a bit of expense for whatever reason. I'm probably going to tell that person, I don't want that property in 24's return. I want you to pull it into 25's return, completely within your rights to do so, because it's going to be more favorable in a debt to income ratio. So those are some of the pieces of advice that I would provide, those and many, many others, for somebody that has provided us with the draft tax return in advance. The other things that we're going to be looking for, we've already talked about the fair rental days. If I know, right, I have that relationship and I know that this was wrong, I'm going to say, go get that fixed. In this case, let's go back down to insurance, which triggered that draft tax return comments. This is blank. There's nothing here. Watch this, you guys. Remember, insurance is an add back. And the reason it's an add back is because I'm taking it away down here. Again, I think that there was a reason that this person didn't have it on there. I don't remember what it was, but for this example, I'm going to show you what happens if it was just a miss and I didn't get to see the draft in time and I didn't question it and say, hey, why isn't there any insurance in here? So let's say that the insurance was just a miss. They didn't get it on there and they filed the tax return. The bell is rung. There's nothing I can do about it right now, unless of course they want to file an amended return, which chances are very low for $1,000 here. Probably won't. But watch what happens to the 436 when I put in the insurance of, say it was $1,000 for the year. I just bought us another, $90, $80 of income. Now that may not sound like a lot, but if you're hovering, right, if your debt to income ratio is at 48.7%, every little bit can help. So those are some of the things that on that draft tax return and why it's so important. My eyes are trained after 25 years to be looking for those holes and asking those questions. Okay, so let's get back on track to some other examples. Let's look at the statements. Okay, statement 7, statement 8, just to see. So let's just say that this person's debt to income ratio is really, really tight and I need to squeeze out every cent that I can. I'm going to be looking in row 14 to see if there's any repairs that I might be able to go back and say, hey, was this a one-time expense? What was this for? Right? And they may be able to say, oh yeah, we had a whole new roof put on. Great. We get to add that $10,000 back. DTI is now a working element. So there's nothing in repairs. So I'm bypassing that, but I do see this one's a decent number, 2375. Let's go and find statement 7. All right. Statement number 7. It's going to be lower on the tax return. So let's take a peek here. Loan cost after refinance. Those are not one-time expenses. I cannot add that back. However, amortization, similar to depreciation, is a paper loss. It is an add back. So while a very small number, it's still worth seeing and sticking in there. So I got to add back as a one-time expense. That's just where we put it as a paper loss. I guess I could add it to the depreciation because that's also a paper loss. So that's where that would go. So we're always going to be looking, fine-tooth combing this to make sure that we're maximizing the individual's buying power or borrowing power. Now, if Mrs. Jones comes to us and we go through this process and she's got a 10% debt to income ratio, I'm not going to waste her time or my time looking for other add backs that we might be able to use. It doesn't matter, right? DTI is already so low. But if debt to income ratio is starting to creep up there, remember we've got 50% threshold, that's when we're going to spend a little bit more time and looking for all of the different ways that we can maximize that debt to income ratio and having those deeper conversations. Let's see. All right, I think this is, what time is it? This is a decent place for a pause. Let me look at the faces of my squad here. How you guys doing? Clear as mud is what I usually like to say, right? Okay. I'm going to stop sharing for a moment. So Schedule E, all right, there's quite a bit that goes into that. You guys can see, and if it's the first time that you're seeing this, you're probably like, what is she doing here? Why is she doing this to me? The takeaway would be, don't file any more tax returns until we've seen the draft. If there's one takeaway here, let me see that draft. If you're concerned about debt to income ratio, or you want to maximize your debt to income ratio for the following year because you've got big plans, let us see that draft in advance so that we can advise you appropriately and set you up for your greatest success. Let's go into, let me just look at some chats here. No, I'm not going to do chats. If you guys have a question, unmute yourselves, please. Let's do our Q&A.
I have a quick question.
Yes, sir.
So for debt to income ratio, that threshold you said about 50%, is it only applied to all your rental income and expenses, or it adds up with if you have a W-2 and then you have a personal expenses as well?
So the debt to income ratio calculation is going to be the income from all sources. So your W-2, your bonus, your commission, alimony, child support, K-1, all the different sources of income that you're receiving. We're going to get that documentation and come up with a monthly number. And then we're going to divide that number by the monthly liabilities that we're going to extract on your credit report. Okay, I don't care what you owe on credit card, the balances. I only care about those monthly expenses. There are three elements, and maybe you missed this up front, Aziz. There's three things that won't be on a credit report that has to be in a debt to income ratio calculation. They are, if you rent as a primary housing expense and you don't own your home, I got to hit you for that. HOA dues and taxes and insurance that you pay separate from a mortgage. Otherwise, everything is on that credit report. I don't care about any other of your normal living expenses. They do not come into play. As it relates to your rentals, the mortgages, more often than not, are going to be on the credit report. If they're not on the credit, I mean, I guess that's a good point. If you have private loans, let's say, and they don't show up on a credit report, or maybe the loan was to an LLC and it's not going to show up on a credit report, but you signed a personal guarantee, we're going to find out what that payment is because we're going to see it on your tax return. And here's where. Let me share my screen again. Share. Here's where, more often than not, here's where that's going to come from. So let's take Aziz's question and talk about mortgages that will not be on a credit report, right? That liability has to be included in the debt to income ratio. The way we're going to see it, probably more often than not, is right here, row 12. If there's interest, or row 13. So see this one right here, 1920 of interest. So it's still interest. So this tells me it's probably a private note. I would ask the question, especially if I don't see a mortgage on this person's credit report. That's where we're going to find it. If it's not listed here, the other ways that we're going to see it are going to be via the insurance deck page that will show a mortgagee clause, right? And or assigns. Anyway, there's a few ways that it's going to come up for us that we would have to include that. But otherwise, minimum payments credit report, all sources of income that we've been able to extract based on specific formulas, including what this one looks like. Does that answer the question, sir?
Yeah, so just a follow-up question. This worksheet only works with your rental income and expenses, not your personal, to calculate the debt to income ratio. You have it somewhere else that adds up all your sources of income with the rental and then calculates the debt to income ratio?
Yes, what we've been looking at today is just the Schedule E calculation.
Okay.
We use a system. So in mortgage lending, there's something called an LOS, loan operating software. There's a few of them. The one most commonly used in our industry is called Encompass. It's a very sophisticated engine that we get to know our clients very intimately in the confines because it allows us to calculate incomes, pull credit, store your income documentation, lock loans, draw loan docs.
You might need that hand sort of getting in forward.
There we go. How does that happen? How do we unmute ourselves? When you ask specifically,
they must be unmuting themselves. The only thing that. Yeah.
But I wonder by accident, because I mean, if I were to mute myself, I'd actually have to get my mouse and push mute.
You do.
Right?
You're right. You're right. I don't know what's going on.
Anyway, Aziz, I got you, right? Does that answer your question, sir?
Yeah, I did. Thank you.
Okay, you're welcome. What else, guys?
Why is the HOA dues an add back? Because that's not in the PITI, is it?
It is. We have to include it because it's a hard cost. I'll share screen again. Hold on.
Okay, so when you do the PITIA, you're
Yep.
including homeowners in that.
Yep. So because it's going to be in this field, right down here in row 23, 24, or A10, depending on if you're looking at the worksheet or the
Yeah.
because it's going to be it's a subtract as part of the hard cost of the property. You can't get away from the HOAs. They're going to be paid. Now, just kind of a subset of that question, property management. That's not a hard cost. You could manage it yourself. So as you can see, that is not going to be included in that final subtract cell. We're not going to take property management away. Only the costs that are hard that must be paid. Good question.
Do you also include the primary mortgage payment in reducing is the primary
Yes.
mortgage payment also taken into account?
Yeah, so in the debt to income ratio, your primary housing expense is going to be included. Now, that's a good question, Jag, because it leads to some follow-up. So one of the things that we'll advise, let's say we get a duo, a team, a husband and wife, there or whatever it may be, and they're just getting started, and maybe they don't have a primary mortgage yet. They're renting, okay? In which case, each of them has 10 full golden tickets, by the way. U-turn, the 10 limit, you guys, is only applicable to rental properties. So if I get somebody that comes to me that is renting right now, they have access to get 10 conventional loans. When they get to number 11, the rule around, and they want to buy where they live, their primary residence, there's no limitation. You don't have that limitation on primary residence. It's only applicable to investment property. So for somebody that's just starting out, they could get the whole 10, and then they could have 30 investment properties with mortgages on them and get an owner-occupied conventional Fannie Freddie mortgage if they qualify. But my point was, if we're strategic about it and we're looking at the qualifications between a couple and one has more substantial, steady W-2 income than the other one may be just starting out with a Schedule C or self-employed, et cetera, and we're deciding maybe we're going to refinance the primary residence to pull cash out anyway because they want to harvest some equity to buy investment property. Okay, there's our example. I'm probably going to say, let's strategically figure out which of those two individuals we want to put the primary housing expense on. Now, this is important and it's freaking complicated. So let's say that we've said that Mrs. Jones has the more stable W-2, lower DTI right now. We're going to refinance the primary, pull 100,000 out, and I'm just going to put it in her name. The mortgage, the debt obligation is just in her name. It will be very important to make sure that he is on title. Okay, he's not obligated to that debt, but he's on title. Because if you guys remember, maybe 30 minutes ago, we were talking about the acquisition year, 75% of the gross rents minus the PITI, right? That's in the acquisition year model of rental income. And depending on whether you have a primary housing expense and 12 months of history being an investor will dictate how much of the 75% gross rents you get to use. I'm going to say it again. So there's 3 buckets. If you have both a primary housing expense and you have 12-month history of being an investor, we can demonstrate that you've got 12 months of having owned rental property, you get the full 75%. If you only have one of the two, right, you have primary housing expense, whether it's rent or you own your property, or you've got 12 months history of being an investor, you do not get the full 75%, you get to offset. So if you remember my example, I said $1,000 of rent, $500 of PITI. Okay, for the individual that has both those two distinctions, they get $750 of income, 75% of 1,000, and the $500 of the PITI gets taken from that, and they're left over for a $250 gain, right? They get to keep that gain because they have both. The person that's in the middle bucket that has only one or the other, they don't get the full $250 gain, but they do get up to $500 to offset. So think about that. I've completely washed the new mortgage debt of this property. So their debt to income ratio, when they came to me, if it was 40%, and they're in that middle bucket, they have one of those two distinctions, it's still going to be 40% because I've covered this new mortgage payment. if those were our numbers. If we had $1,000 of rent and the payment was 500, they don't get the gain, but I can give them up to the PITI. And
So,
then the third person, they get none of the rental income. So let me just really quickly, Jag, finish that thought. So if the individual is not on the mortgage, that's okay. I'm not going to hit them, and they're not obligated to that debt. But if they're on title, I'll hit them for the taxes and insurance. They have that ownership. So I'll hit them for a much smaller amount, just the monthly taxes and insurance, so that I can give them both of those distinctions, primary housing, and if they have the 12 months history, and that person would get the full. Is that helpful?
yes, that's helpful. So that means that at least you're not carrying the cost of the mortgage, but you are
Correct.
carrying the cost of the taxes and insurance.
As a primary housing expense to ensure they get the full gain on that
Right.
acquisition year formula. Right. Now
So-
there's another rabbit hole real quick that we can go down. So when we have couples come in, right, and they're really wanting to maximize the golden tickets, et cetera, and one of them has all the income, the other one is staying at home with the kids, whatever it may be. There are very strategic ways that we can take that couple and say, okay, this partner is going to get all of the mortgages, but they're going to have title ownership, maybe some LLCs, et cetera. As we move on, and actually the individual that's here with us that we're looking at their Schedule E today, they have been brilliant at this. They've done such a good job. Neither one of them has their W-2s now, right? They're all on their Schedule E. They've got, I don't know, 10, 11, 12 properties now. So they figured it out. They were able to accomplish what we're talking about. We're all here to do. But the point being is that they were very smart about who was on title to what, because the individual that didn't have the W-2 at first, we were able to make sure that she was on title to the properties on this Schedule E. Am I still sharing? I'm not still sharing. On the Schedule E that showed the most gain, right? We kept her on title to the properties that had the gain on the Schedule E, so that, and she didn't have a lot of monthly income. And you guys, it's not about the income really, it's about the income in relation to the monthly debt. When we talk about debt to income ratio, you don't need to make $10,000, $20,000 a month. We have clients that make $1,000 a month because their credit report shows this much of monthly liability, right? Their DTI is below that 50% threshold. But back to my point, in their case, she didn't have the W-2 income. He did. They were strategic about which properties we kept her on title for, because she's on title, and that Schedule E, she gets to keep that income, right? That income is legitimately for her. And then maybe some years we said, this property is showing a pretty big loss and they want the loss for the tax benefit. So we would take her off title to that one. Changing title is as easy as calling an escrow or even the county yourself and executing that quit claim deed, or changing the bylaws of the LLC to show no ownership, right? There's a lot of ways to skin that cat to maximize income or loss for tax benefit and continue to qualify one or the other for long-term optimization and success. That was probably a TMI or a lot. How did you guys do with all that?
Well, that was very informative, but yeah, I like that because I've been through a few of those myself. You can go a long ways in this whole strategy kind of thing.
You sure can.
Yeah.
You really can. If you're working with someone that really understands the guideline and what we can do. I mean, Fannie and Freddie are very clear. There's a 1,400-page document called the Seller's Guide that tells us exactly what we have to do to have them purchase this mortgage-backed security, which basically means they're insuring against default. So we talk about what this really means. Let's kind of drill down a minute and boil it down to its purest form. The Fannie Freddie loans, the reason that the terms are better is because you've got a United States guarantee against default. So when mortgage-backed securities are bought and sold and traded on the secondary markets, the ones that have Fannie and Freddie backing it are going to be more secure. So you're going to get the better rates and terms. Anyway, so there are the guideline, the seller's guide, as it relates to non-owner occupied loans, very, very specific. And Ridge knows those guidelines like we know our own face. Very, very familiar, because it's what we do. And we know how to navigate the battleship in a creek, as I like to say. Anyway, Jag, I'm sorry. Did you have something else on there?
Yeah, that was actually really helpful. I'm so sorry, I have another meeting starting, but
Okay.
I was curious how you took into account rentals. I think you actually answered all my questions, Caeli. I was just as I went through and looked at it. Do assets help you qualify if your debt to service ratio is not optimal? Can your assets help?
You sure can. So there's something called asset depletion. Fannie Freddie allows for it as well, as does non-QM products. The calculation is going to be a little bit different, but if you have substantial assets, we can show either a 36 months of continuance of income, and sometimes the guidelines will require 120 months. So just as an example, I can't do mental math. Let's say that we know that we're short $2,000 to get debt to income ratio in a space where we need it. Okay. But the individual has a liquid account that shows a face value of 72 grand. Okay. I can take that $72,000 if it's in the right kind of account, divide that by 36 months. That would give me the $2,000 I need in income to offset that debt to income ratio. So it's called asset depletion. Yes, we can do it. The assets have to be able to show a 36-month continuance in most cases, and it has to be in like self-directed IRA, maybe a brokerage. But yes, Jag, we can. Tap me and we can talk further. I know you got to go.
Thanks very much.
You're welcome.
Sorry, I have a question, Caeli.
Hi, Lorena.
Hi. How come like Ridge does all of this extra work to like make us look like we have a good DTI? And like last year I went to my credit union and asked for a HELOC and they like laughed me out the door because my DTI was so bad.
Thank you for asking that question. We're holistic. We're not transactional. I've just never been one of those people that's as interested in some one-off commission as I am in being a primer or you guys, this is complicated stuff. And it's taken me 25 years to establish myself as an expert in my space. And you can't get this stuff online, right? And anybody know where you could find this if you were just to do a Google search, dear Google, that you could get this information? And I think that it's useful and necessary. It's like there's this lead veil, right? Where you can't get access. And then how do you get over and figuring out how you're going to create this wealth or this lifestyle that you're hoping to achieve without the information? It's kind of like, a good old boy or good old gals club where they won't let you in the door, right? They won't give you the information. And I've always been abundance mentality, never scarcity. So I don't know, Lorena, if that answers the question, but it's just always been what we do. We want to provide the information and create the relationships, not some one-off transactional deal. And by the way, that's actually a good segue for me. This has been a pet project I'm working on. It's probably another year or two out. We'll see how ambitious I am. But RLG University. So all of this is going to be created in a very linear fashion so that you guys will have access to it. Now, we may end up charging for that, okay? In every capitalist way I can think to communicate it. There will probably be at some point, if real customized, because it'll be customizable based on your circumstances. It'll be reasonably priced, but at some point down the road, RLG University will be available for our clients. And what I'm really excited about is our clients' kids. We're going to be doing classes. Maybe I've talked to a few of you about this. We're going to be doing classes, maybe in a group setting, I'm not sure, with like 13-year-olds up to 25-year-olds, where our kids, we want to be able to impart some of this to them in a meaningful way so that they have some of this tangible information when they want to go out and start investing themselves, because it's just such a great legacy. I wish I would have done it sooner. I know all of us that have started to get our kids involved in some of it probably feel the same way, that if I could have just, anyway. Thank you for saying that, Lorena. That was a nice question. What else, guys?
So Caeli.
Oh, go ahead.
Thank you. So Caeli, why the discrepancy in Schedule E income from a personal return versus a business return? Why does Fannie do those separately or differently?
Yeah. So what he's talking about, for anybody that missed it, or just as a recap, Fannie Freddie rules say that if you've personally obligated the debt, Bruce, you have obligated the debt. It's in your individual name, or you sign that personal guarantee. If that is how you've structured the mortgage, but you're taking it and putting it on a business tax return, the rule is you cannot take a gain, but I will hit you for a loss up to a maximum of the property's PITI. So either you've got to put it on your, and so that's their rule. It's personal versus business, right? If it's on a business tax return, it's a business thing, but you've personally obligated, and they say no. And CPAs, so people will come to me and say, my CPA says I have to do it this way. I have not been able to. And, you know, Ridge, we've got probably 3 different CPA groups that focus on investors that we'll give referrals to and, you know, say, hey, call these guys if you need help with CPA. I have not, of those 3 anyway, and I've not had anyone else be able to tell me differently. I don't see any tax, okay, tax incentive or benefit to do it the bad way. Personally obligate the debt and then file the business tax return. I do not believe. Now, if it's a K1 and you're paying yourself a wage, that's a different conversation, okay? But short of that, there is no tax benefit of doing it that way. So there's no reason not to put it on your personal Schedule E. You don't get anything less or more out of it. Bruce, I don't know if that answers your question, but that's it. We'd have to call Fannie to say why, if there's another reason other than what I just described.
Right, but why? So then the way to game the system would be to maximize your income on your K1 or pay yourself a salary to sort of juice your debt to income.
Yes. Now,
juice your income.
Yes, if you're going to do a corporation, a C Corp or S Corp, usually it's an S Corp, and we're going to take the K1. So if the K1 shows a loss, you're going to get hit for that loss. Even if the Schedule E there shows a gain, the K1 will be a loss. That's a little bit of a rabbit hole, Bruce. We can look at it. I think that probably for time purposes, maybe we'll do that next time. But if there's a loss on the K1, depending on how big the loss is, may not be a problem because you've actually started to pay yourself a wage, right? $5,000 a month or whatever it may be, you're paying yourself a wage. The K1 would be reflective, but you'll have that as a loss if it shows a loss on box 1 of the K1.
Yeah, real quick answer to that also is that I'm kind of a retired CPA. You can actually just take your LLC, make it as a sub S, pay yourself a wage, and that will benefit you there. And you can also help with the professional investor in that too, that you're getting paid to manage your properties. So that's one thing to consider there.
So I want to add to that, Andrew. Thank you. And we'll have you guys. We'll do more of these. We'll make it a series. The real estate professional exemption. Since we have a CPA on here, maybe he's able to talk a little bit more. And I got a few minutes. Real estate professional exemption. So for those of you that are not familiar with this is where you're able to demonstrate to the IRS that you're spending more time on this. I think it's 750 hours a year. That ends up being about
correct,
250. Yeah. Okay. About 2 hours a day if you were to break it out. Now I may be a little bit more aggressive here than somebody else. Okay. So consult your tax professional. I am not giving you legal advice. Okay. But you know, when you think about it, when you break it down, so you guys, we've been on the phone for an hour or on this call, an hour and 14 minutes. This counts against the 750, as far as I'm concerned. And I would encourage an audit to say that it didn't, or an auditor to say that it didn't, but this is part of your education. So this would count against that 750. Now, if you have a full-time job that you work 40 hours a week, they're going to say that it's going to be harder to prove. Now, I don't know that I agree with that necessarily, because, and here's why. So I have a full-time job. Okay. Granted, I'm in this space, but at the height, when I had 42 properties and dealing with property managers and scouting properties and you know, taking a long weekend and flying to Memphis to look at properties and all those different things, I was I kept my log. I did everything I was supposed to do. I was able to legitimately come up with more than 750 hours a year in participation. So I claimed it. I think I had 9 properties the first time I did. Andrew, do you want to add to that?
But the log is key. That's what's going to save you.
Yeah.
Have a spreadsheet, something, make a log and just put in hours as you go along that you're spending on that. And that will make a world of difference with the IRS, you know, not just saying, well, I know I did 2 hours here, 2 hours there, you know,
right.
Document.
Yeah. Or your online surfing, right? You're vetting properties and property management, whatever. Frickin' put it in the log.
And I don't understand why they say full-time job, because full-time job is 40 hours a week. Well, just you can certainly spend 20, 30 hours a week on an extra job. I mean, people do it all the time. I don't know why that would be anything.
Yeah. Anyway, I mean, listen, and if you're audited, that's when whatever. I'm not even gonna get in that. Okay, we got a few more minutes here before we wrap up. If you guys have, I'm thinking, so when I finally get the debt to income ratio, because this is kind of, well, it's part one because it's the first one we're doing, but chances are when we do, I'll probably do 3, maybe 4 of these so we can get into each of the different schedules and some other details I think that are going to be valuable and important. Once we put it all together on YouTube, this will probably end up being part 3. If I had to guess, I'm kind of doing it out of order. But if you guys have specific needs, whether it were you gleaned it from this conversation, or that you are one that needs to hear more about Schedule C or K or whatever, shoot me a line and I'll be more prepared next time. It'll be more linear in my thought process. I won't have just had knee surgery in my Christmas pajamas. What else? Anybody say last
question on Caeli. The Ridge Lending Group, RLG. Do you guys do the regular convention loan besides all-in-one? I thought you could only do all-in-one loan.
That's a perfect, this is a perfect segue to close this out. So just very, very quickly, you guys, Ridge Lending Group is a direct lender. That means that we fund on our warehouse line. We underwrite most of our products in-house. We do not service these mortgages. So that means that, a couple times a month, we're bundling up the mortgage-backed securities and we're selling them on the secondary market to what I call an aggregator. You guys are going to call them servicers. You know who you make your mortgage payment to. They're going to pick up the rights for the mortgage-backed securities and service those mortgages. We are full service. So we don't only just work with investors. We work with owner-occupied VA, FHA, USDA, you name it. The Fannie Freddie, the all-in-one is my favorite product. We have short-term bridge loans for fix and flip or fix and hold. We have commercial loan products. Mr. Vincent Scott has been working with Pauline. We've had some bumps in the road, but I think we're back on track, Vincent. I'm not sure. He's been doing a lot of commercial rehab renovation stuff. We have ground up construction. We have commercial products for residential and commercial. You get the point, Aziz. There's very, very little we can't do. If there's one thing that comes up occasionally that I don't have any access or even a good referral for, is bare land. I got nothing on the bare land side. Otherwise, you'd be hard pressed to say that we've got no access to what it is you're trying to do.
I'm just curious, where were you guys been hiding all this time? I just only knew about you do all-in-one HELOC loan, and that's where I found you guys out.
Where'd you find us? Bigger Pockets or podcast or something?
Real Wealth. Remember I did the Real Wealth?
Yeah. That means that I have to fire my marketing team, Aziz. I don't know what's happening. I'll have to have a conversation with them. I've never been a big social media person. I've kind of rejected it to my disadvantage, I'm sure. Maybe that's why. That'll take me down.
I had a very tough time with one lender, DHI, but it was pretty tough to get even the loan, and I had to drop it in the middle of the loan process.
Which one was it? A DSCR?
No, the Fannie Mae was another mortgage company. DHI.
Oh, okay. Yeah, and that kind of plays into what's called an overlay. I'll definitely leave you guys with this one. So overlay. So because we are a direct lender, we sell to many different of the aggregators, right? So we have a very diverse playing field in which we can take, and from our warehouse line, let's say we funded a loan for $500,000. I've got lots of different places that I can then sell that to free up the line. So most banking institutions are going to be limited to a much smaller box, in which case this box probably comes with what we call overlays. So use the Fannie Freddie 10. Okay, Fannie Freddie, the purest form of that guideline says per qualified individual, you have access to 10. B of A says, I think B of A, I'm just picking on one of them. No, you can't have more than 4. So while Fannie Fresh, we can do 10, B of A for risk layering is going to impose an overlay and say, nope, you can't have more than 4. Add backs like like depreciation. You may find a bank that on a Schedule C, they won't let you add back your depreciation because it's an overlay. So there's all kinds of things out there that you can find that are going to prohibit or preclude the use of certain banks, but non-owner occupied. Early on when I first got into this, so Ridge is a second generation company. My dad founded it. He retired back in like 2005. He was the one that decided he didn't want to be competing with the real estate agents and the owner occupied, and he thought he was so smart to do that. And then 2008, 2009, got our asses handed to us, but we survived, and I still am a huge proponent and believe very strongly in real estate as a diversified means of investing. Okay, I'm just talking to hear myself talk now, Aziz.
Oh,
If you,
Yeah, that's
yeah,
fine.
Yeah. Okay, yeah, real quick. I had to go up 2 level supervisors with Rocket Mortgage to get them to add back the depreciation in my Schedule E. They did not want to do that at all. It was just
Yeah.
blew me away,
you knew more than them, right? As the borrower,
I had to literally school them. Yeah, it was just kind of ridiculous. But I had one quick question on the 10 properties for Fannie and Freddie. Your personal residence counts, doesn't it count
Yes.
10 if you have it beforehand? Now,
Yep.
if you can get 10 and you don't have, then you can get a personal mortgage and have 11 that way. But it's my understanding that if you already have your personal residence mortgage, then you have to count it as part of the 10. Is that correct?
Yes, sir. Yeah, I'm glad you brought that up because it might have been confusing when I was detailing that earlier. So the rule is what counts against the 10 is any residential property. So single family to 4-unit, fourplex and below is residential that has a loan on it in your name or personally guaranteed by you is going to count against the 10, which if your primary residence has a mortgage on it, it will count. Now, when we talk about reserves, just as a little bonus bit of information, the reserve requirement does depend on how many finance properties you have and what the formula and the calculation is. And your primary residence will count in the number of finance properties. But when we actually calculate the reserve, we will not take the loan balance of the primary in coming up with that number. But yes, it counts because it's a residential property. If it has a mortgage on it and it's in your name,
and you're right, it's not as big a deal as it used to be because the DSCR is the best thing that ever happened the last few years. Yeah. The spread, like you say, you can get DSCRs. I just got one for 6.1%. So like you can get.
Did you really?
Well, I got right when the dip happened in like August,
September. The 19th of September.
Yes, I happened to just lock it in then, and it was just pure luck, basically.
Good for you.
Locked in then, but you're right. But the spreads on those have come down so much that it's almost like a conventional.
Well, and pay attention, you guys, for those that are interested in this kind of stuff. Under Trump's reign, there is very serious consideration that the conservatorship that Fannie and Freddie has been under for 15, 16 years, whatever, is probably going away. Calabria, who was the head of the FHFA when Trump was in office before, unsuccessfully tried to unwind. I think there's some benefits to doing it, but they need to do it the right way. The capital requirements, I think they've come up with all that. Anyway, pay attention to that because the conservatorship, if they end the conservatorship, that means that spread that you're talking about, Andrew, between a DSCR, for example, and a Fannie Freddie will probably narrow even more. And what I'm most excited about if that happens is that the adjustable rate mortgage is going to make a comeback. So we've been on an inverted yield for the since 08, 09, where ARMs on a 30-year AM basis have priced higher. The rate on a 5-year ARM is higher than a 30-year fix. So there's been no incentive. Right?
I just noticed that here recently because I got a new personal residence on. So let me see what an ARM's like since rates are so high and everything like that. Because I ended up getting a conventional and I had to go to 7.2 or 3%. Yeah. Because I was in a bad period. This was earlier on. But you're right. I looked at the adjustable and there was just no point in doing it. It just wasn't cost effective at all. Yeah.
And the truth of the matter is, you guys, an ARM, I'm such a big fan of an ARM. If you take a minute and you really consider statistically, the shelf life of a 30-year fixed mortgage for an owner occupied is about 7 years. Okay, the percentage of people that get a 30-year fixed mortgage and stroke a check 360 times later to pay that thing off is a fraction of a percent. And that's even going to be true for the pandemic rates. You watch. We are hedonistic. We want what we want. Those 2% and 2.5% interest rates, which are amazing, they're going to be in debt. and they're going to be paying 20 and 25% interest on their credit cards, and they're not going to have any way out, and they're going to have to refinance those mortgages. Not everybody, but I'm telling you that an ARM, well, okay, I'm leaving. We're going to do another one soon, I promise, and I will be more prepared and less pajamaed out.
Thank you very much for all the information.
You're welcome, Aziz. Yes, my
Well,
friend.
I'll end on this comment. Anybody paying 25% on your credit card, you're simply crazy now with the balance transfer liberalization that they utilize, that you can literally bounce them off each other and keep renewing that and everything like
True.
that.
If you have good enough credit, if your credit score is good enough, right?
Yeah. I mean, well, that's true. And if you have, because I have like 36 credit cards and I bounce them around each other.
Yeah.
I've never paid interest on credit card debt, and I've kept 90 to 100,000 for years.
Good for you.
Well,
Well,
because
maybe we'll do
I started doing businesses with it because it's the cheapest form of credit. 0%.
Maybe we'll do a course on that, Andrew. Yes, Lorena.
Oh, I was just going to say that I was looking through the chat because I know you didn't have a chance to. And one of the questions that people kept asking was about that form. So if you want to just have somebody like send the form to everybody who came to the webinar, or go through there and look who wanted it.
Yes, thank you. I will have, so Avery, the lovely Avery I'll have her posted on the community. But yeah, well, you know what? Yeah, I'm sure she can get an accounting of everybody, and we'll just send a blind email to all of you, and we'll stick it on the community as well. And if you guys want to mess with it, do it and send it over with your return, and I'll grade you. I'll score you and tell you how you did. Okay. I'm out, you guys. I'm getting on. I'll see you soon. Happy holidays, and you know how to get us if you need us.
Yes, everybody have a happy and safe holiday.
See ya. Bye, guys.